If you're still sitting on the fence about whether you should go buy a capital city or can you even afford to buy in a capital city, then this is the video for you. In today's video, I'm going to talk about the data associated with buying in metro markets versus buying in regional markets and where you could be in the future as a result of that choice, as well as what's happened in the past so that you can make a better decision moving forward for yourself or your family. G'day there, my name's Ben Everingham. I'm the director here at Pumped on Property. Now, if you haven't already done so, please subscribe to our YouTube channel. If you like this video, please give it a thumbs up. Now, metro versus regional is a huge topic of debate for so many different people, and in today's video, I wanted to bust another myth so that you have an advantage over all of those people in Australia that think the gains in regional markets long term are going to be anywhere close to those in metro markets. Now, when people think metro markets, they think expensive, and I'm sure they think negative cash flow, which is why so many people probably look at the regional markets around Australia and choose to invest there. But I'm going to, again, by the end of this video, completely blow that myth out of the water, because a lot of Australia's metro markets are very, very affordable right now. In fact, you can buy a lot of the metro markets cheaper than many of the regional markets. So I'll tell you about some of the markets that we like, both metro and regional as well. So I recently received an email from Tim Lawless, who's the head of research at CoreLogic. Now, he'd done, and his team had done, a study on metro markets in Australia and regional markets over the last 20 years. And what he found is that the metro markets had performed over 80% better than the regional markets in Australia over the last 25 years. Now, that was comparing the 7 largest metro markets in Australia versus the regional markets in Australia. And when I'm talking metro, I'm talking Sydney, Melbourne, Brisbane, Perth, Canberra, Adelaide, Hobart. I think they even throw Darwin in there now as well. So they're the big metro markets. Now, that is a huge amount of money to leave on the table. You know, over 3% per annum. If you had have gone 25 years ago and bought your average regional market versus your average metro market. Now, as always, huge disclaimer, every single property market is unique in itself. Now, while the average metro market has done better than the average regional market over 25 years, some regional markets like Byron Bay, for example, have gone off their head and hammered the performance of even the big metro markets. So again, this is general information for people like myself that are only going to buy a small number of assets in the future. Now, when you get a piece of information like metro markets outperform regional by 80% in the last 25 years, it completely shuts a whole lot of opportunities for me in the future out of what I will buy, and that is all the regional stuff. Because someone who's only going to buy a small number of investments that has a very low risk profile and has a young family, I want to be making sure I'm getting the highest and best use of my dollar when I spend it. That means buying a metro market. Now, let's look at some of the positives and negatives outside of that huge piece of information, which is the 80%. Now, one of the things that I love about regional markets is they have strong populations. Now, if you look at Sydney, we're at over 5 million people. I think Melbourne's about there now as well. Brisbane's sitting at over 2.3 million people. Obviously, Perth's sitting at over 1 million people. And the thing about lots of people living close together is that resources get tighter. Now, what I mean by that is it's just the law of rent. And there's been some incredible research over the last 200 years on this, where premium sites like properties close to the city, or properties with a water view, or properties walking distance to the beach or a suburb back from the beach, have historically performed a lot better than properties that are on the fringes of the big cities or that are further away from these cities or in the regional markets. Now, you can look at Michael Matusik's research on this stuff, which is absolutely gold, CoreLogic's or BIS Strapnell's as well. But the fact that there's a larger population there is fantastic. I also love the fact that there's population growth in the future. Now, the Australian Bureau of Statistics has come out and said that over the next 10 years to 25 years, over 75% of Australia's population growth is going to go to Sydney, Melbourne, and Brisbane or southeast Queensland. Now, when you think about that, 75% of the jobs, the infrastructure, the population and the incomes are going into 3 concentrated areas. Now, I'm not a gambling man, but I know to not bet against the house. And so if you're just looking at a few quality investments over your lifetime, then you really don't want to roll the dice on regional markets, and you certainly don't want to roll the dice on markets. Now, over the short term, anywhere can win. You know what I mean? It's like rolling the ball with roulette, which I do enjoy playing about once a year with my mates. And, you know, picking the lucky number, like picking the one number out of whatever amount, and, you know, or rolling the dice and calling it a 1. You know, there's a chance that you could pick the one regional market, or you could pick the one property that performs extremely well, but most of the time the house is going to roll you. And because we know where the population growth is, we also know where the jobs are going as well, and we know where the infrastructure is going, we can not try and beat the house by doing something different than what they're telling us is going to win. And we can just play, okay, I'm playing the conservative 75% gain because I know that I'm going to only buy 1 or maybe 5 or 10 properties maximum over a lifetime. I want every single dollar that I have to be working for me as much as possible. Now, some of the things that I do like about regional towns, because there are massive positives. I live in one right now, which is the Sunshine Coast, and it's a beautiful place. And like I said, in a shorter period of time, 10 years, any regional market in Australia could beat any individual metro marketplace if the metro market just sits flat or declines and the regional market's in a good stage set for growth. But over the longer term, which is what I look at, 20, 30, 40 years, and passing those properties on to my children so that they get the best start to their life, that's what I'm talking about here. Now, something I do like about regional markets is there's a huge lifestyle benefit. Now, the sunny coast is absolutely gorgeous. The Gold Coast is beautiful. There's actually places all over Australia that are absolutely gorgeous, and they continue to attract people like me that want to come up here and get a job or retire or look after my family or raise my family with a bit of a different perspective than what you could get in the big cities. So there's a huge benefit. But outside of that benefit, sometimes these regional markets do get good short-term population growth or medium-term population growth. They can also go through bouts of really good infrastructure spending, which is what the Gold Coast, Sunshine Coast, Geelong, parts of Australia are starting to see now. But there's also some negatives associated with these more smaller regional markets. Now, one of the big negatives for me personally, and it's a huge negative, is the fact that they are generally dependent on 1, 2, maybe 3 industries. We all know the person that lost a lot of money in the mining town. Few people know the people that made a lot of money in the mining towns. Places like the Sunshine Coast, for example, while they do have a good education sector, a good healthcare sector, a good construction sector, they're still very, very heavily dependent on tourism. And that is fine when the global economy is going well. But when the global economy is not doing well, or the national economy is not doing well, people pull back, start saving money, and one of the easiest ways to save money is on those lifestyle expenditures. So the fact that they've just got one industry is not something that I love, or a number of industries. You think about a lot of the towns around Australia that aren't tourism and mining related, they might be a one-trick pony. It might be farming, it might be some sort of agriculture, it might be some sort of natural resource, but generally they're constrained. And as soon as that big boy or that big player stops pulling money into the town slowly dissolves over time, or sometimes if it's in a coastal area, can get itself through the long-term lifestyle benefit. And you've seen that in Wollongong, you've seen that in Newcastle, as those places were so heavily dependent on coal and resources, and now they've sort of transitioned into education hubs and major employment hubs because of the population growth that's flowed over from Sydney. Similar sorts of things happening in Geelong, Bendigo, Ballarat, Sunshine Coast and Gold Coast. Like, they're the sort of big towns that you really want to be understanding regionally. Another thing that I like is the fact that incomes are lower. Now, incomes, regardless of what people say, to me is one of the key indicators of future performance of an area, because let's say, for example, this regional town has an average household income of $800 or $900 a week versus Sydney or Melbourne that has an average household income of $2,000 a week, or Brisbane, for example. Now, these incomes are so important because it affects what people can pay for rent, it affects what people can pay for property values in the future as well. And unless they get a huge surge of infrastructure or population growth, which is generally short-lived as opposed to consistent long-term, then incomes really matter. Now, another thing that concerns me with regional towns is their vacancy rates. Now, what generally happens in a regional town is it's almost always either completely oversupplied with property, which is very dangerous as an investor, or completely undersupplied with property. Now, generally, when you look at supply and demand, there's great indicators like the number of rental properties available, the vacancy rate, which for me, when I'm buying, I like to see a town or a metro market or a suburb with a vacancy rate below 2%. Anything over 3% signifies to me that you're oversupplied. Anything under 2% is chronically undersupplied. We've seen Perth in the last few years have vacancy rates as high as 15%, then they've gone to 6%, now they're sitting at just over 3%. What happens is when vacancy rates get really, really tight, it generally means that the area is in high demand, or that you'll be able to fill your investment property a little bit sooner if you're realistic on price than not. Now, what happens in a lot of these towns that are heavily dependent on one or two industries like mining, tourism, education, farming, resources, or agriculture, these smaller areas, is that they're never in perfect harmony long term. Generally what happens is they're oversupplied, then the developers they're undersupplied, then the developers oversupply, they have a vacancy issue, then they undersupply again, and it kind of moves like that, where good quality areas in metro markets or capital cities, there's some suburbs that just don't have any more land available, and the local council won't increase the density. So the vacancy rate is more consistent, you kind of know what you can expect, and that is very important from a cash flow perspective. Now, one of the benefits that we didn't talk about with a regional market can be cash flow. Now, because property prices are more affordable and because property prices are lower, rents can obviously be more affordable as well. They normally most regional markets in Australia sit at a cash flow perspective of somewhere between 4 and 7% in terms of the rent return, which is a nice position to be in if you're an investor looking to hold a property. Now, obviously there's more advanced strategies like building a secondary dwelling or a granny flat to increase the cash flow, but generally cash flow is better in regional markets. Now, a problem particularly with Sydney, with Melbourne, and for me with Canberra at the moment, is the fact that the cash flow is just so negative right now. Now, I'm certainly not an investor that believes in going out and buying an asset and hoping in today's values that the past repeats itself and it keeps growing in value over time. A lot of people still come into property with that mentality that the past is going to keep repeating itself, and while it has for hundreds of years in Australia, America and Europe, I think we have to be a bit more conservative looking forward, knowing that things aren't going to double every 7 to 10 years like they did in the past, which means cash flow is increasingly becoming important. So when you're paying $1 million for a property in Sydney or Melbourne and you're only getting $500 or $600 or $700 a week in rent, obviously you're pulling money out of your pocket each week, and that's fine to do when property prices are increasing by 3 or 5% per annum, but really, really hard to do when property prices are declining by 5, 10, 15 or 20% per annum like they are in some of the markets around Australia at the moment. So cash flow is very important. Generally, investors with a good cash flow position and a lower debt to value ratio position survive the bad times. If your property is cash flow positive, it gives you a buffer against interest rate rises or a buffer if you lose your job, or a buffer if everyone starts losing their job or their tenants, where people that are really constrained cash flow wise, that are paying lots and lots of money out to hold a property that may or may not be going up in value, are the ones that get sort of forced into selling them at the wrong time. And that's why 60% of Australians actually lose money on properties they buy within the first 5 years that they sell, just because, you know, it's a long-term game. So I really like metro markets personally. That's where I'm going to build my portfolios. For me personally, if you are interested in regional markets in Australia, you can check out Heron Todd White's month in review report. I also like the Sunshine Coast. I do like the Gold Coast. I like Wollongong and Newcastle. I do like Geelong long term as well. But you've got to understand where each of those markets are at. You know, Geelong might be at peak of market or starting to decline, as with the Gold Coast, where Brisbane might be started recovery. You know, Wollongong and Newcastle are clearly dying right now and in the declining phase, or if they're not right now, they will be very soon with the overflow effect of Sydney. But it's just really important to keep a finger on the pulse, to know that, you know, just because something was good yesterday or last year doesn't necessarily going to mean it's good this year, and you've got to understand that timing and learn how to do that, which CoreLogic or BEIS Strapnel or HTW can be really good data sources to start to try and understand this stuff better. Now, in terms of the metro markets, like I said before, 75% of Australia's population, job and infrastructure growth going into Sydney, Melbourne and Brisbane. You can guarantee that's where I'm going to be, or Southeast Queensland, putting my money. I'm just not going to roll against the house, and I'm just going to go with the flow. In terms of those markets in 2019, Sydney and Melbourne will continue to decline. They've gone through an incredible growth cycle in the last 10 years, where Brisbane, according to CoreLogic, is now cheaper to buy today than it was in 2008 when you factor in inflation, which is powerful when you understand 50 years of history where Sydney, Melbourne and Brisbane have all done over 9.5% per annum, with Brisbane actually performing the best over that period of time, according to Homely's data. So I hope I've made it very, very clear that I am much more metro orientated. Obviously, over the next 20 years, some regional markets will do better than the metro markets, but on average, if you're the average person looking to buy 1, 2, 3, 4, 5 properties over your lifetime, you know, have a look at this stuff. Now, when I talked about affordability with metro markets, right now we're buying houses on the beaches of Brisbane and within 20 k's of the city for between $350,000 and $450,000. Now, these properties are getting really good rent returns and the vacancy rates are very, very low at this stage. Then we're helping clients, if they're interested in building a granny flat, and maybe in some instances, some clients just want a very low maintenance property, others want a property that they can add some value to. So if the client would like to add a granny flat, we're seeing yields as in between 5.5 through to 7% available in Brisbane right now, walking distance to the beach and close to the city. So like I said, you don't need a fortune to go out there and buy a good metro market. There are so many good options in Brisbane. Possibly in the future there'll be good options again in Perth that are affordable, that people can sink their teeth in, that haven't gone through crazy growth in the last 10 years, that represent really good timing. So thank you so much. If you're interested in buying in the next 12 months, I'd like to offer you a one-on-one complimentary strategy session with either myself or my brother Simon. Just jump over to www.pumpedonproperty.com. Please book a strategy session where we can talk about where you are, where you would like to be. We can talk about the Australian market as it stands right now, and I can give you some different ideas, and then you can choose to either go off and do it on your own with some good new information, or you might choose to become one of the clients that we take on each month and work with us. But either way, I wish you all the best. All the best. Please subscribe to this YouTube channel and check out our podcast, The Pumped on Property Show. It's certainly not a time right now to go crazy, although with Liberal getting back in, with APRA relaxing some of its lending guideline or policy directions, and the Reserve Bank dropping rates and looking like they're going to drop them again later this year or early next year, sentiment is going to start to slowly improve over the next few years, and some markets in Australia are definitely worth starting to wrap your head around now. So I wish you all the best. Have a great day, good luck investing, and stay safe.